Most people spend decades building their retirement savings, watching every dollar, maximizing every contribution, doing everything the financial books told them to do. And then, in the final stretch, right when they think the hard part is over, the government quietly reaches into their pocket and pulls out thousands of dollars a year. Not through taxes, not through penalties, through a single three-letter word most Americans have never heard of until it's already too late. That word is IRMAA. And in 2026, it is about to hit harder, faster, and wider than ever before. This is what nobody is telling you. There is a moment that happens to thousands of Americans every single year. It happens quietly, without warning, without a phone call, without a meeting. It arrives in the mailbox, a letter from the Social Security Administration, usually just a few weeks before Medicare coverage is set to begin. And when people open that letter and see the number, the first reaction is almost always the same: confusion, then disbelief, then a slow sinking feeling that something went very, very wrong. Because the Medicare premium written on that piece of paper is not what they expected. It is not the standard rate they had planned for. It is not the number they saw on the government website. It is significantly, sometimes shockingly higher. And the single reason this happens, there's a rule most financial advisors barely mention, most retirement planning books gloss over, and most Americans only discover after it is already too late to do anything about it. That rule is called IRMAA, Income-Related Monthly Adjustment Amount. And understanding it, truly understanding how it works, what triggers it, and more importantly, how to legally prevent it, is one of the most financially consequential things a person approaching retirement can do in 2026. Because this is not a small surcharge. This is not a minor inconvenience. For some retirees, IRMAA can add thousands of dollars annually to their Medicare costs. And it does it silently, automatically, based on income you earned 2 full years before you even enrolled in Medicare. Think about that for a moment. The income you earned in 2024, every dividend, every required minimum distribution, every withdrawal from a traditional IRA, every dollar of Social Security benefit is right now, today, determining what you will pay for Medicare in 2026. And if certain assets are still sitting in your name, structured the way most people structure them, you may already be in the danger zone without knowing it. What most people are not seeing is that IRMAA does not just affect the wealthy. It does not just apply to people with million-dollar incomes. The 2026 brackets are set at thresholds that catch a massive segment of middle-class retirees, people who spent their careers being responsible, saving diligently, doing exactly what society told them to do, maxing out their 401k, reinvesting dividends, holding real estate. And now, in retirement, those same responsible financial decisions are generating income that Medicare is treating as a reason to charge them double the premium their neighbor pays. This is not a tax. This is not disclosed prominently on any government website. But it functions like a hidden penalty on success, and in 2026, it is more important than ever to understand exactly how it works. Let us start with the mechanics, because the mechanics are where everything becomes clear. Medicare Part B, which covers your doctor visits, outpatient care, and preventive services, has a standard monthly premium for 2025 of $185 per person. For a married couple, that is $370 every month just for Part B alone. Now, for most people earning below the threshold, that is exactly what they pay. But the moment your modified adjusted gross income, your MAGI, crosses a certain line, Medicare applies an IRMAA surcharge on top of that standard premium. And the surcharges are not trivial. They are structured in tiers, each one more expensive than the last, stacking on top of each other based on how far above the threshold your income sits. For 2025, the first IRMAA tier begins when individual income exceeds $106,000, or $212,000 for married couples filing jointly. At that level, your monthly Part B premium jumps from $185 to $259 per person. That is an additional $74 per month per person, nearly $900 a year per person, just for crossing one income threshold. But that is the smallest tier. And here's where it gets significantly worse. At the second tier, when income crosses $133,000 for individuals, the monthly premium climbs to $370. The third tier, at $167,000, brings it to $480. The fourth tier, at $200,000, pushes it to $591 per month. And at the highest IRMAA tier, for individuals earning above $500,000, the premium reaches $628 per month. That is nearly $450 more per month per person than the standard premium. For a married couple, both enrolled in Medicare, that is over $10,000 more annually in Medicare premiums alone. That is before Part D, the prescription drug premium, which also carries its own separate IRMAA surcharges, stacking on top of everything else. Read that again. A married couple at the highest IRMAA tier could be paying over $10,000 more annually just because of income reported on their tax return 2 years earlier. Now here's the detail that changes everything, and the detail that almost nobody explains properly. The income Medicare uses to calculate IRMAA is not your current income. It is not your income from last year. It is your MAGI from your tax return filed 2 years before the benefit year. So in 2026, Medicare is looking at your 2024 tax return, not 2025, not what you're earning right now, what you earned in 2024. This 2-year look back is the single most misunderstood element of Medicare planning, and it is the reason people get blindsided. Because by the time you claim Social Security, by the time Medicare coverage kicks in, by the time you receive that letter, the income year in question is already closed. The tax return is already filed. The income is already recorded. And there's nothing you can do retroactively to change it. Your only leverage is what you do before that tax year closes. Your only window is the years leading up to the Medicare calculation. And that window, for many people approaching retirement in 2026, is narrowing rapidly right now. This is where the 3 assets become critical, because not all income is created equal in Medicare's eyes. The Social Security Administration, when calculating your IRMAA bracket, looks at a very specific definition of modified adjusted gross income that includes wages, business income, capital gains, dividends, interest, required minimum distributions from traditional retirement accounts, rental income, and even the taxable portion of your Social Security benefits. But here is what it does not include: Roth IRA distributions, distributions from health savings accounts, life insurance proceeds, and certain other tax-free income sources. This distinction between what counts toward IRMAA and what does not is the foundation of every legitimate strategy for protecting your Medicare premiums, and it all comes down to how 3 specific categories of assets are structured, positioned, and timed before you claim Social Security. The first asset category is the one that causes more IRMAA disasters than anything else, in every demographic, at every income level. It is the traditional IRA and the traditional 401k. These accounts are the cornerstone of American retirement savings. Tens of millions of people have them. The money went in tax deferred, which felt like a win at the time. A legitimate tax benefit, a smart financial decision, the kind of move every financial professional recommended for decades. But here's the problem. The government has a rule called required minimum distributions. Beginning at age 73 under the Secure 2.0 Act, the IRS requires you to withdraw a minimum amount from these accounts every single year, whether you want the money or not. And every dollar of that distribution counts as ordinary income. Every dollar goes directly into your MAGI calculation. Every dollar pushes you closer to an IRMAA tier, or deeper into one you are already in. What most people are not seeing is how catastrophically large these RMDs can become for people who spent a lifetime saving aggressively. Someone who consistently maxed out their 401k, who earned reasonable returns, who reinvested dividends. They might walk into retirement with a traditional IRA balance of $700,000, $800,000, $1 million or more. At a life expectancy table factor of around 22 at age 73, that $1 million balance generates a first-year RMD of approximately $45,000. Add a spouse with their own IRA, add Social Security benefits, a portion of which are taxable, add interest from any savings accounts or CDs, and suddenly, a couple who genuinely considers themselves middle class, who lives modestly, who has no intention of spending extravagantly, finds their MAGI sitting at $150,000, $180,000, $200,000 or more. And Medicare does not care about your lifestyle. Medicare does not care that most of that income is not cash you are actually spending. Medicare looks at the number, locates the bracket, and sends the surcharge letter. This is not theoretical. This happens every year to millions of people who never saw it coming because nobody explained the connection between their 401k balance and their Medicare premium. The strategy for this asset, the single most powerful move for protecting your Medicare costs, is the Roth conversion. And the timing of that conversion, executed correctly in the years before you claim Social Security, is what separates the retirees who control their IRMAA exposure from those who are permanently locked into expensive brackets. A Roth conversion is the process of moving money from a traditional IRA into a Roth IRA, paying income tax on the converted amount in the year of conversion, and then allowing that money to grow and be distributed completely tax-free in the future. Roth distributions are not counted in your MAGI. They do not appear on the income lines that Medicare monitors. They are, for IRMAA purposes, invisible income. And for someone facing a decade or more of potentially large RMDs, converting strategically during the years between retirement and Social Security, claiming can dramatically reduce the taxable income profile they carry into Medicare. The key insight is this. There is typically a window between when someone stops working and when they begin collecting Social Security and RMDs, where their taxable income drops significantly. During this window, which might be anywhere from 2 to 8 years depending on when they retire and when they claim, converting portions of their traditional IRA to Roth each year at a controlled tax cost can dramatically reshape their retirement income landscape. By converting now at a carefully calculated amount each year that keeps total income below the IRMAA threshold, you are essentially prepaying taxes at today's rates to avoid a future situation where both the taxes and the Medicare surcharges hit simultaneously. The math is frequently compelling. The protection it provides is real, and the window for doing it is finite. But here's where it gets more nuanced. Roth conversions, done in the wrong amounts in the wrong years, or without accounting for other income sources, can themselves trigger IRMAA surcharges. A conversion that pushes your 2024 MAGI above $106,000 as an individual means Medicare 2026 will charge you at Tier 1 surcharges. A conversion that pushes you above $133,000 means Tier 2. This is why the Roth conversion strategy must be executed with precision, converting just enough in just the right tax year to achieve the long-term reduction in MAGI without accidentally creating the very IRMAA problem you're trying to solve. This is not a set-it-and-forget-it strategy. It requires analysis, projection, and usually the involvement of a tax professional or fee-only financial planner who understands both IRS regulations and Medicare rules simultaneously. But when done correctly, the protection it provides lasts for decades. The second asset category that must be evaluated before claiming Social Security is the taxable brokerage account, the non-retirement investment account that holds stocks, mutual funds, ETFs, bonds, and other securities. This is the account that sits outside of any IRA or 401k wrapper, funded with after-tax dollars, subject to capital gains taxation and potentially annual dividend taxation even if you never sell a single share. And it is one of the most commonly overlooked sources of IRMAA triggering income, particularly for people who have held these accounts for many years and accumulated significant unrealized gains. Here is the specific problem. Every dividend payment a mutual fund or stock makes in a taxable account is reported as income on your tax return, even if you automatically reinvested it back into the same fund. Every year, without any active decision on your part, that account is generating taxable income that flows into your MAGI. For someone holding a large brokerage account, perhaps built over 30 years of systematic investing, the annual dividend and interest income generated can be substantial, tens of thousands of dollars annually in many cases, all of it counting toward the IRMAA calculation, all of it pushing the bracket higher. And if in any given year they also sell positions, perhaps to rebalance or to fund living expenses or to make a major purchase, those capital gains stack on top of the dividends and can cause a sudden severe spike in MAGI that sends them into a higher IRMAA tier for the corresponding Medicare year 2 years later. What most people are not seeing is that the structure of the assets inside that brokerage account matters enormously, not just the account's total value. A brokerage account holding high dividend-paying stocks or actively managed mutual funds with high annual distributions is fundamentally different for IRMAA purposes from a brokerage account holding tax-efficient index funds or individual growth stocks that produce minimal annual income. The first structure generates visible MAGI every year automatically. The second structure keeps income largely invisible until securities are actually sold. The strategic move for someone approaching Medicare age is to evaluate whether the taxable brokerage account's current holdings are generating more annual taxable income than their retirement plan can absorb without triggering IRMAA surcharges. If they are, and for many retirees they are, repositioning those assets into more tax-efficient structures before the look-back year closes is a legitimate and legal method of controlling Medicare costs. There is also the question of unrealized capital gains and how to manage them intelligently. Someone holding positions in a taxable account that have appreciated significantly over many years faces a compounding problem. The gains are large. Selling them triggers a capital gains event that spikes MAGI, but continuing to hold them means the portfolio remains concentrated and unbalanced. The solution is not to sell everything at once. The solution is to use the years before claiming Social Security, particularly years when other income is low, to harvest gains in controlled, strategic amounts, staying within IRMAA thresholds while gradually repositioning the portfolio. This technique, sometimes called strategic gain harvesting, turns a potential tax and IRMAA catastrophe into a manageable multi-year process, and it is far more effective when started years before Medicare enrollment than when attempted in the final months before claiming. The third asset category is one that has become dramatically more relevant in the past 2 to 3 years because of the interest rate environment, and it is one that even financially sophisticated people frequently overlook. This is the category of interest-bearing cash and fixed income assets. high-yield savings accounts, certificates of deposit, treasury bills, treasury notes, money market funds, and bonds held in taxable accounts. These assets are generating income at rates that were essentially zero for over a decade. Then, beginning in 2022 and continuing through the period leading to 2026, interest rates rose dramatically. A high-yield savings account that was earning 0.5% in 2020 is now earning anywhere from 4 to 5%. A ladder of treasury bills or CDs is generating similar returns. And for retirees who prudently shifted to more conservative, interest-bearing assets as they approached retirement, as every conventional financial advisor suggested, this interest income is now flowing directly into their MAGI in amounts they never anticipated when they built their plans. Consider a retiree with $500,000 in a combination of CDs and high-yield savings, earning 4.5% annually. That generates $22,500 in taxable interest income every single year. Add that to even modest other income, a pension, partial Social Security, small IRA distributions, and the IRMAA threshold is suddenly within reach. For someone who genuinely believes they are living on a comfortable but modest income, that hidden interest income, sitting quietly in what feels like a safe and conservative account, is steadily building their MAGI toward a bracket that will cost them hundreds or thousands of dollars more in Medicare premiums every year. And because interest rates remain elevated relative to historical pre-2020 levels, this problem is more acute in 2026 than it has been in a generation. The strategy for addressing this asset class involves evaluating whether those interest-bearing assets can be repositioned, at least partially, into structures that generate tax-advantaged or tax-exempt income. Series Y bonds, for example, allow deferral of interest until redemption, providing some control over when that income appears in MAGI. Municipal bonds, particularly those issued by your state of residence, generate interest that is typically excluded from federal taxable income. A properly structured Roth IRA, funded through conversion or direct contribution in years when income is low, can hold fixed income assets and generate interest that never appears in MAGI at all. None of these are magic solutions, and none of them are appropriate for every person in every situation. But the principle is consistent. Interest income in a taxable account is IRMAA visible. The same economic value of income generated inside the right account structure may be IRMAA invisible. The asset itself is not the issue. The wrapper it sits in determines its impact on your Medicare premium. Now, there is a broader strategy that connects all three of these asset moves, and it runs directly through the question of when to claim Social Security. This connection is frequently missed even by people who do careful retirement planning, because Social Security timing and Medicare planning are typically treated as separate conversations. They are not separate. They are deeply, mechanically linked. Here is why. When you claim Social Security, Medicare Part B enrollment is typically triggered automatically if you are already age 65 or approaching it. Your Medicare premium is then calculated based on your MAGI from 2 years prior. So the year you claim Social Security, or more precisely, the years immediately leading up to Medicare enrollment, is exactly when IRMAA calculations are crystallizing based on recent income history. If you have been executing Roth conversions, repositioning brokerage assets, and restructuring interest-bearing holdings during the years before claiming, you have been actively managing and suppressing your MAGI during the precise period that will govern your early Medicare premiums. But if you delayed all of these strategies, if you waited until the year you actually claimed Social Security to start thinking about IRMAA, you may have already locked in 2 or 3 years of high MAGI that will generate IRMAA surcharges for your first 2 or 3 years of Medicare coverage. This is why the strategies discussed in this script are not retirement strategies. They are pre-retirement strategies. They work best when started 4, 5, or 6 years before the anticipated Medicare enrollment date. Every year of proactive MAGI management in that window is a year of potential IRMAA savings once Medicare begins. According to informed sources familiar with retirement planning dynamics, the most common mistake advisors observe is clients who come in at age 63 or 64, having done no IRMAA-oriented planning at all, with large traditional IRA balances, active taxable brokerage accounts, and now interest-bearing cash generating 4+% annually. At that stage, the Roth conversion window is short, the available tax budget for conversions is constrained, and the ability to meaningfully reposition assets without triggering the very MAGI spike they are trying to avoid is limited. The people who successfully protect their Medicare premiums are overwhelmingly the people who started this planning at 58, 59, 60, when time was still on their side and every financial decision still had maximum flexibility. There is one additional mechanism worth understanding deeply, because it offers a specific form of MAGI reduction that is uniquely powerful for people who are already in or approaching required minimum distribution age. That mechanism is the Qualified Charitable Distribution, or QCD. The IRS allows individuals who are 70 and a half or older to make direct transfers from their traditional IRA to qualifying charitable organizations, up to $105,000 per year in 2024, with that limit indexed for inflation going forward. The critical distinction: a QCD satisfies the required minimum distribution requirement for the year, but it is excluded from taxable income entirely. It does not appear in your MAGI. It is not counted for IRMAA purposes. The distribution happens, the RMD is satisfied, and for tax and Medicare purposes, that income never existed. For a retiree who is already charitably inclined or who makes regular donations to a church, a nonprofit, a university, or any qualifying organization, the QCD strategy can effectively remove tens of thousands of dollars from their MAGI every year. For a couple, each with their own IRA, the potential annual QCD contribution can be $210,000 or more, representing an enormous potential reduction in MAGI. If their RMDs are driving them into an IRMAA tier they would otherwise avoid, QCDs can bring them back below the threshold, not through some complicated tax maneuver, but through a straightforward IRS-sanctioned charitable giving mechanism that accomplishes something they intended to do anyway. The money goes to causes they care about. The IRMAA surcharge disappears. The Medicare premium drops. And the charitable deduction is, in this structure, already embedded in the tax exclusion, meaning they do not need to itemize to benefit from it. There is also the health savings account strategy that deserves mention, even though its IRMAA protection window is fundamentally different from the others. An HSA, a health savings account attached to a high deductible health insurance plan, offers triple tax benefits. Contributions are tax deductible, growth is tax-free, and distributions for qualified medical expenses are tax-free. If someone in their 50s or early 60s is still working and covered by an eligible high deductible plan, maximizing HSA contributions during those working years creates a reservoir of tax-free medical spending power that, in retirement, can cover out-of-pocket healthcare costs without generating any MAGI at all. Instead of taking an IRA distribution to pay for a medical expense, which would increase MAGI, they distribute from the HSA tax-free. The medical need is met. The IRMAA meter does not move. For someone facing significant anticipated healthcare costs in retirement, this distinction between an IRA dollar and an HSA dollar, when used for medical spending, can represent meaningful IRMAA protection. But here's a critical warning that must be stated clearly, because it is where many people make a painful and irreversible mistake. Once you enroll in Medicare, you can no longer contribute to a health savings account. Medicare enrollment, even just Part A, disqualifies you from making new HSA contributions. This means that for people who delay Medicare enrollment, perhaps because they are still working and covered by an employer plan, the HSA contribution window may extend somewhat. But the moment Medicare begins, that window closes permanently. Contributions made after Medicare enrollment are considered excess contributions and create a tax penalty. This connection between Medicare enrollment timing and HSA contribution eligibility is yet another example of how the entire system, Social Security claiming, Medicare enrollment, IRMAA calculation, retirement account strategy, is not a series of separate decisions, but a single, interconnected system where every choice has cascading effects on every other element. Now, let us address something that most retirement content almost never mentions, and which provides a lifeline for people who have already received an IRMAA surcharge determination they believe to be inaccurate or outdated. There is an official process called the IRMAA Life Change Event Appeal. The Social Security Administration does use 2-year-old income data as its default, but they also recognize that life circumstances change. If your income has dropped significantly from the year they are using, because you retired, because you lost a job, because you experienced a divorce, because a spouse passed away, because you stopped working due to illness, you can formally request that the SSA use more recent income information to recalculate your IRMAA determination. The form is called SSA 44, the Medicare Income-Related Monthly Adjustment Amount, life-changing event form. Filing it with appropriate documentation can result in a recalculated premium based on more recent lower income, potentially removing the RMA surcharge entirely or reducing it to a lower tier. This is not a loophole. It is a formal, documented, intended part of the system, but it requires that you know it exists, that you understand the qualifying life change events, and that you act quickly enough after receiving the RMA determination to file and benefit from the recalculation. For someone who retired in 2024 and now finds their 2026 Medicare premium reflecting their higher working year income from 2024, this appeal process may be the fastest path to premium relief, provided the retirement itself constitutes a qualifying life change event, which it typically does if it resulted in a meaningful reduction in income. The broader message, the one that ties every piece of this together, is that Medicare premium planning and Social Security claiming strategy are not passive activities. They are not decisions you make once and then forget. They are active, ongoing, multi-year financial disciplines that require coordination between tax planning, investment management, retirement account strategy, and benefit timing. The people who successfully navigate this system and arrive at Medicare with controlled, optimized premium exposure are not necessarily the people with the lowest income or the smallest retirement accounts. They are frequently the people with substantial assets, people who have genuinely built meaningful wealth, who understood early enough that the structure and timing of that wealth matters as much as its size. A person with a $2 million Roth IRA pays the same Medicare premium as a person with no retirement savings at all, assuming all other income is below the threshold. A person with a $2 million traditional IRA, taking required minimum distributions, may be paying $600 more per month per person in Medicare premiums for the rest of their lives. The difference is not wealth. The difference is structure. And structure is something that can be changed, optimized, and strategically managed, but only during the window of time before the relevant tax years close and the IRMAA calculations crystallize. In 2026, the stakes are higher than they have been in recent memory. Interest rates remain elevated, meaning interest income is appearing in more retirees' MAGI than at any point in the past 15 years. The IRMAA brackets, while indexed for inflation, have not expanded enough to prevent a large wave of middle-class retirees from being caught in surcharge territory as RMDs begin on decades of compounding retirement savings. The combination of higher interest income, growing RMDs from large traditional IRA balances, and the 2-year look-back rule is creating a perfect storm of IRMAA exposure for the cohort of Americans now entering their late 60s and early 70s. And Social Security, which most people correctly view as the cornerstone of their retirement income plan, is the trigger that sets Medicare into motion, making the timing of that claim more strategically consequential than most people realize until they are already inside the system. According to informed sources in the retirement planning community, the single most valuable shift a person approaching retirement can make right now is to stop thinking about Social Security timing, Medicare enrollment, Roth conversions, and RMD management as separate topics addressed in separate meetings with separate advisors. These elements form a single, unified system. Every decision in one area reshapes the outcome in another. Claiming Social Security at 62 instead of 67 does not just change the monthly benefit amount. It changes when Medicare begins. It changes which tax years become the IRMAA look-back years. It changes how many years are available for Roth conversions before RMDs begin. It changes everything downstream. And downstream is where the real costs live, quietly accumulating in Medicare, surcharges, tax brackets, and missed optimization windows that cannot be reopened once they close. The real story is not about 3 assets. It is about a system that rewards people who understand it and silently penalizes those who do not. The 3 assets, the traditional IRA and 401k, the taxable brokerage account, and the interest-bearing cash and fixed income holdings, are simply the 3 most common and most impactful places where that reward or penalty dynamic plays out most visibly. Addressing them before claiming Social Security is not about finding a loophole. It is about understanding the rules of a system you are already enrolled in and making decisions with full knowledge of how those rules will apply to your specific situation. But here's the question that should sit uncomfortably at the edge of every retirement plan being designed or reviewed right now. What happens to retirees who do none of this? What happens to the millions of Americans who claim Social Security without IRMAA awareness, who never executed a Roth conversion, who never evaluated their brokerage account's annual income footprint, who never considered whether their CDs and high-yield savings were quietly building their MAGI toward a surcharge they never anticipated? The answer is not a catastrophe. It is not a financial crisis. But it is a decade or more of overpaying for Medicare coverage they could have received at a lower cost. It is money that leaves their retirement portfolio every single year, that cannot be recovered, that reduces their financial margin, that may eventually constrain their choices in ways they never foresaw. For some retirees, the cumulative IRMAA overpayment over a 20-year retirement is well into the 6 figures. For others, it is smaller, but it is almost never zero, and it is almost always avoidable with enough planning done early enough. The question that remains, the one that does not have a clean answer, the one that makes every projection and every strategy feel slightly provisional, is what happens to the IRMAA thresholds themselves in the years ahead. The brackets are adjusted annually for inflation, but the formulas, the income definitions, the tier structure, the surcharge amounts, those are policy decisions made by Congress and executed by CMS. And in an era of rising entitlement costs, demographic pressure from the aging baby boom generation, and ongoing political debate about the solvency of Medicare and Social Security, there is no guarantee that the rules of the system will look the same in 5 years as they do today. The brackets could widen. They could narrow. The surcharges could increase. New income sources could be added to the MAGI calculation. New exemptions could be created or existing ones removed. The 2-year look back itself is a policy choice, not a mathematical necessity. Everything about IRMAA is ultimately subject to legislative change. What does not change through every modification of the Medicare system since IRMAA was first implemented in 2007, is the fundamental principle that the structure of your income matters as much as its amount. Tax-free income has consistently been treated differently from taxable income in Medicare calculations. Roth distributions have consistently remained outside the Meiji calculation. QCDs have consistently provided Meiji relief for charitable retirees. These structural advantages exist within the system, as it is currently written. And taking full advantage of them in the years before claiming Social Security is the closest thing to a reliable, durable strategy for protecting Medicare premium costs that currently exists. The people who will pay the highest Medicare premiums in 2026 and beyond are not necessarily the people with the most money. They are the people who made the right savings decisions for the wrong reasons, who built wealth in the wrong account types for the coming rules, who crossed finish lines they did not know existed, and the people who will pay the lowest premiums, who will watch their neighbors open those surprising letters from the Social Security Administration while their own Medicare statements reflect standard rates, are the people who understood, years earlier, that retirement planning is not just about accumulation. It is about structure. It is about timing. It is about knowing which rules govern which assets at which moments in your financial life. It is about making decisions today based on where the consequences land 2 years from now, and 5 years from now, and 20 years from now. Because in the world of Social Security and Medicare, the choices you make before the system locks in are the only choices that truly count. And for most people, the window to make those choices is narrower than they think. The question is whether they will act before it closes, or open a letter one day and wonder what went wrong.